Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Advanced Auto Parts Incorporated, ticker AAP, a stock that had earnings this morning and was beaten up by the markets, down 35% during market hours, down 1 cent after hours. But we'll take a look at the numbers, see what the valuation was before heading into these earnings, and if this is an overreaction or what's going on. We start with the revenue. I have changed up the format here a little bit to try and make it a little bit easier to read, get some more numbers for us to look at, and let me know what you guys think about all of this. I want to work in more methods of evaluations so we can really decide what a good stock to buy would be. And then we can really dive deep on those buys. We start with the revenue as always. We want to see it between 5 and 10% growth year over year. It's at 4.7, so it's just shy of what we'd like to see. Cost of goods are 4.3% year over year, which is, we'd like to see those more stagnant, but it is coming in below the revenue growth. Gross profit percentage, they seem to have a gross profit around 45%. Has climbed up a little bit since 2019. Their expenses are a big issue here. Their expenses make up 93.5% of their revenue this last year. So they are running on very thin margins with very high expenses, and that's something that they're going to need to work on. They end up with an EBIT that's grown a little bit over time, very slowly from 677 to 699. Net income, their net income percentage tends to be about 5%. I added their estimated guidance for this year, the updated guidance with this earnings. So we see that they are still expecting, with the decrease in guidance, very, very small growth, essentially no growth in the top line revenue. The margin, they're expecting 5%, which is pretty in line with what we've seen here before. And then their earnings are where things are different. So we'll get back to this one. Analysts are expecting a drop in earnings for this stock, and a drop would be a generous term. So the previous guidance for this from this company was earnings between $10.20 and $11.20. I mean, they came in at $13.04 this last year, so we're starting off with a decline. But in their earnings, they say that they're expecting between $6 and $6.50. So we see that, that 1064 at the current share price after the drop would have been a 685 PE. Historically, they're around 20%. I mean, we see 23, 22, 25, 12. So the market was projecting some slowdown and maybe a decline as of last year. And now it's definitely coming to fruition. So if we just update this to the low end, we see our valuation metrics down here. Currently, the stock would be valued at $266 off their earnings. Moving forward, $217 off what analysts expect. But if we update this to be $6 instead of the $10, that PE with the current stock price jumps to $12.15, and the earnings valuation drops to $122. So there's a huge cut they're taking in, the main driver for their value here. And then the dividend was the other driver for their value, which they cut as well. They cut it down to 25 cents a quarter. It was $1.50, and they had grown it very, very quickly, and they had it sitting down at a low point about 25 cents a quarter for quite some time. The balance sheet is nothing pretty. Their tangible assets are decreasing very quickly, yet their total assets are increasing. So there's a lot of goodwill. There's a lot of funny money going into that balance sheet. The common stock equity is declining, so you're losing your share of the company, and the debt is climbing. So that's why the equity is declining, because you see a huge climb in the debt and a very small growth in the assets, even though it is just a lot of funny money accounting. Ordinary shares, we do see that they have been decreasing shares. So they're buying back at 5% a year. That is something that we do like to see. That's the one bright side coming out of that balance sheet portion. Cash flows, they're not huge on cash flows. Their cash flow is decent, but apparently it's going to be bad enough that they had to cut the dividend. We see that there's been a decline over the years in their operating cash flow. The investing cash flow, I mean, they invest quite a bit of money. It grew significantly this last year. Financing, they've been very heavy recently on their financing cash flow, and they've been just dwindling away at their cash. Their cash was pretty high back in 2020, and it's been cut down to nearly a quarter of what it was. They had $13 a share in cash, and now they have $5. So that's something that's kind of important for a stock. I mean, we at least know that the absolute bottom for the stock would be $5. And so we come down to a free cash flow that has been declining. Last year was a terrible year for free cash flow on them. They need to get back up to those 2021 levels. Right now, they're at a free cash flow per share of about $5, which would give them about $100 in value. If they continue with the decline that they've been experiencing, it dropped down 95 or below. Dividend, they slashed their dividend. I mean, if they had held it, with them raising it so quickly, this is very skewed, because we say that the market likes it around 1.6%, but they're paying out $6 per share. So this number was not anything useful. Going forward, $60 would be a pretty fair. Yeah, that'd be a pretty fair metric, $60 for that dividend that they're going to cut it down to. So what we're seeing here is low margins, rising expenses, not good. Lowering assets that matter, rising debt, not really good. Falling cash flow per share, cutting the dividend, again, not good. So I'm almost going to have to rate this one a sell. So here we have the chart. As of last year's financials, $200 would have been pretty fair for the stock. And we see that that was a resistance point back in 2015. It hit up that high, and it spent quite a bit from 2021 to 2022. So it spent almost a year above that valuation. But now with these new numbers, that valuation gets cut in half, down to about $100. And I mean, it's down. That would make $75, about that range, fair value on the stock. That's right where it's sitting at after the cuts today. So it's sitting somewhere between fair value and a value buy price. Definitely with the metrics, we were already seeing a decline heading into this year, and they're just talking about how it's continuing. So I don't think it's really a stock to be touching. I mean, let's take a look at the earnings and see exactly what they have to say about it. The net sales increased 1.3%, operating income of $90 million on a margin of 2.6%. So that's just a small margin. Comparable stores decreased 0.4%. They have a lot written out here. I had skimmed through it. It was nothing too important. Here the financial outlook, where they cut it from 11.4 to 11.2. They're expecting a decline in comparable store sales. The margin cut from 7.8 to 5. Tax rate stays the same. Earnings cut from 10.2 to 6. We're just working completely off the low end here. If things come in above here, they'd be a nice surprise for us. Capital expenditures, they at least plan to spend less money. Free cash flow, they actually give a range now, 200 to 400 to 200 to 300, which if we look back at the cash flows here, free cash flow, that's down 30% from what it was last. Assets, total assets did grow. As for liabilities, current liabilities are up from last year, and total liabilities are down. Long-term debt is down. So it looks like they're at least handling the debt a little bit. Shareholders' equity is down. Here we go. Net sales, as they said, they were up slightly. Much lower operating income, less than half of what they came in last year. I mean, I see that there's an extra 80,000 in selling, general, and administrative expenses, which really cuts this down. Interest expenses, they spent way more on interest. Their debt and their expenses are just out of hand, and it's really dragging the company down. Net income, way down to almost a third of what it was last year. Basic earnings per share, moving from 228 to 72. These are just not good things that we're seeing here. Let's see if we can find those free cash flows. Cash flows from investing activities. Okay, so they had lost money last year. They actually made some this year in financing activities. And they ended up losing 43,000. I mean, that's a tenth of what it was last year, but still, don't want to be losing money like that. Free cash flows are negative. And, that's really what we're looking at. And that continues to tell the story that we were seeing, where it's just decline everywhere. I wish I had done this video before the earnings happened, so I would have probably ready to sell at that point, just with what I was seeing in the numbers. But it's a definite sell now. I mean, it's probably dropped to about fair value, and we'll keep it on our radar because it could bounce back over the next few years. Because if they can get back to what they were, it was pretty impressive. Very, very impressive how quickly they were growing their dividend, and just the earnings that they were able to pump out per share. But that's all for this one. I want to thank you guys for watching. Please like, comment, subscribe. Let me know what you want to see, and I will catch you next time.